Hey guys, today we're analyzing the incredibly controversial stock known as Tesla. So hopefully I don't get too many haters for making this video, but yeah, Tesla, it's like either you hate it or love it type of stock. But today we're gonna try and do our best to just look at numbers. And I actually owned this stock way back in the day when it was like 12 bucks a share. And then I sold them at like $18 a share. I thought I was a genius. I made like an 80% gain or something. And then they continue to go up like crazy. Uh, yeah, so that was before I really knew how to value a company. So let's go through the numbers here. Tesla, here's their 5-year chart. They had this incredible run, and then it's been kind of like a slow down cycle for the past 2 years. Let's check their market cap is 520 billion. Very large company. Price to earnings ratio of 37. Pretty steep, so let's see if they have some growth. Let's check out their financials. Here is their annual financials. Let's zoom in to this. Okay, here is their revenue growth. So revenue growth has been really, really good since 2017. But what we really have to be concerned about is the revenue growth going forward. And we'll talk about that later, actually. So past revenue growth, really, really good. Their gross profit also has been going. Operating income. So the thing that I noticed is that in 2022, they had a gross profit of 20 billion, and then an operating income of almost 14 billion. And then last year it actually dropped to 9 billion, so their margin got squeezed. In fact, let's check out what else do we want to look at? Okay, their shares outstanding have been increasing, so they've been diluting shareholders, which is not usually what you'd like to see unless they're using it to fund growth. In the case that they're using it to fund growth, then it could actually be a good thing. Check their balance sheet. They have negative 20 billion in net debt, so actually they have a really, really good balance sheet. In terms of cash flow, their cash flow is less than their earnings, so they had 4 billion in cash flow and 7 billion last year. In comparison to their income last year was 12 billion, and then I mean 2 years ago was 12 billion, and last year was 15 billion. So their cash flow is much, much lower than their net income. Probably because of these tax credits right here, 5 billion in tax credits. Let's check their stats. Um, return on invested capital right here at 25, which is actually really good. And then their net margin right here. Actually, yeah, their net margin is pretty good, especially for last year, probably because of that tax thing. But their operating margin right here is only at 8, which is actually really bad. So their operating margin is very, very low. Not very profitable, in my opinion. Uh, they really need to get this up higher if they want to return value to shareholders. Let's check. Okay, so let's go to their slides, and we can get a lot of good information from this. We can get so much good information from their slides here. So this is their total automotive revenue for the last 5 quarters. And we can see it goes from 21 billion to 19 to 21 to 19 to 21. It's kind of all over the place, and year over year, it's only a 1% gain. So it kind of seems like their automotive revenues have actually stagnated, which is not what you like to see for a company that derives most of its revenue from cars. I kind of believe that most of the people that want an electric Tesla and can't afford it have actually already bought it, and the demand is starting to dry up here. So I don't know if there's much growth in their electric vehicle sales moving forward. Total revenue has been pretty flat, actually. Their energy storage revenue has been flat. Their services have been increasing slightly every single quarter, so that's a bright spot, at least. Let's keep going down. There's lots of good information here. This is on a yearly basis. So 15% year over year in total automotive revenues, but based on the quarterly results, kind of seems like that growth is stagnating here. Let's see here. What else can we look at? Oh, they also have that new Cybertruck. Not quite sure if anybody else saw that. Well, obviously, if you're watching this video, you for sure saw the Cybertruck. I personally hate it. It's gonna rust. Yeah, that's my opinion on that. So hopefully you guys don't hate me for that. Model 3 and Y production and deliveries. So that has been increasing all the way up to 19%, but their margins on those have declined, and that's why the revenue hasn't gone up. Their solar deployments have actually declined a lot, minus 59% in the last year, and their storage deployed has been pretty flat. Yeah, this is their Model 3 Y deliveries, and then their other model deliveries is only 22,000. So this really is a Model 3 Y company. The rest of the cars don't really make much of a difference. Here's some stuff about how much they can produce with their different factories. Okay, this is something I kind of wanted to talk about. So here they put their cumulative miles driven with full self-driving has been just going up like crazy, and then wait. No, this isn't that interesting actually. Battery powertrain. But if you believe that their AI full self-driving is actually going to become a thing, then hey, then this is a great time to buy the stock. But I kind of hate how they call it full self-driving because you can't actually leave your hands off the wheel. It's very, very misleading. In terms, oh yeah, this is okay, energy storage has been going up like crazy, right? But then if you look at solar, they say their solar deployments declined by 41 megawatt or down to 41 megawatts. So if their energy storage went up, their solar went down. So they're going to, of course, show you energy storage, but not show solar at all, which is kind of annoying. They always try and paint a rosy picture, so you really got to watch out for that with every company that you analyze. And that is about it, I think. Yeah, that's about it. Let's go to the DCF model I have on these guys. So I put in their earnings per share estimate coming from Yahoo Finance. Let me show you the Yahoo Finance estimates. So for next year, they have $3 for their earnings per share as the average estimate. Actually, there's a massive difference between the low and high estimate here. And then the average for the year after that is 4. And yeah, once again, a massive difference between low and high estimate. And then we've got the revenue estimate at 108.5 billion and going up to 130 billion. Another thing, the low estimate is 96 and the high estimate is 166. So massive difference between the two. There's not much of a consensus, and on average, it's going to be a 20% growth number for next year. Well, after next year. So I put those numbers into this DCF model. 3 earnings per share, and then growing by 30% up to $4 a share. Buybacks of 0, revenue of 108 billion going up to 130 billion right here with the 20% revenue growth. Their net debt of negative 20 billion right there. Exit multiple of 22 because they have a lot of room to run. I think exit multiple of 22 is fair. Discount rate of 10% because I want a 10% return. Earnings growth of 30% and then declining thereafter. We get a fair share price of $103 per share. And then with the revenue and margins, I've got 20% growth and then declining after that. I think this is rather generous for their revenue growth. I know they've got lots of different segments, But really, this is a Model 3Y company at the end of the day, and I really think consumers are tapped out on those. So I don't think it's going to continue growing like it has. And in terms of profit margin, their margins have really been squeezed. And if they didn't have any tax credits or anything, they would be in negative territory for profit margin. So I also think that 10% profit margin is actually generous. Their margins have, and they're in a very competitive landscape with vehicles, and even solar products is very competitive. There's lots of different companies offering solar products. So I think 10% profit margin is actually generous for these guys. And using this model, we come to a fair share price of $91, a long way away from the $163 that they're trading out right now. So I think if Tesla dropped down to like $100, I might consider buying them, but not going to be touching them right now. Maybe if you're expecting less of a return, maybe like 5%. 5%, you're still overpriced. Maybe at like 3%. 3% discount rate, still overpriced. I think if you're buying Tesla today, if the AI story doesn't really play out and they are a car company at the end of the day, you're expecting like a 2% return moving forward, which is not very good. Personally, I'm staying away from the stock. If you haven't been able to tell by now, if you have any questions, leave them in the comments. I'll be sure to answer those. And you can also try out this spreadsheet for yourself. That's in the, I got a link in the description for you. Otherwise, hit that like button, and I'll see you in the next video.